you have taken the crucial first steps. You have reviewed your budget, found a little extra money to invest, and perhaps you have even opened a tax-advantaged account like a Roth IRA. But when you log into that account for the first time, you are immediately confronted with a new problem. A blank search bar and thousands of different stocks, mutual funds, and ticker symbols. The most common hurdle beginners face next is looking at the thousands of available investments and feeling entirely paralyzed. The financial industry thrives on making investing look incredibly complex. There is an entire ecosystem of media outlets and analysts who want you to believe that building wealth requires multiple monitors, daily trading, and the ability to predict global economic shifts. In reality, the most efficient way to build a robust, long-term portfolio is remarkably boring. Today, we are going to outline a specific foundational index fund portfolio. This is the exact framework many institutional investors and rational wealth builders use to capture market growth without the stress of picking individual stocks. Here's the big picture. When most people first decide to invest, they try to pick winners. They look for the next revolutionary tech company or a disruptive medical startup. Statistically, this is a losing game. Research consistently shows that over a 20-year period, the vast majority of professional fund managers, people who do this for a living with teams of analysts and supercomputers, fail to beat the average return of the broader market. If the professionals cannot consistently pick the right stocks at the right time, a beginner investing their paycheck after work is highly unlikely to do so. Instead of trying to find the needle in the haystack, the most logical approach is simply to buy the entire haystack. This is achieved by building a simple, structurally sound index fund portfolio. Let's look at the mechanics of how this is actually constructed. When you hear the word diversification, you might assume it means buying shares of 10 or 20 different recognizable companies. Perhaps a software stock, a retail chain, and an automaker. But true diversification is much broader and far more systematic. We are going to build what is commonly referred to in the financial world as a three-fund portfolio. Think of this using an architecture analogy. When engineering a high-rise building, structural engineers do not rely on a single massive steel beam to hold the entire skyscraper up. They distribute the weight across a vast grid of smaller, interconnected support structures. If one individual beam weakens, the building does not collapse because the load is carried by the rest of the framework. An index fund portfolio does exactly this for your money. The foundation of your portfolio is a total U.S. stock market index fund. Instead of guessing which American company will dominate the next decade, this fund buys you a microscopic fraction of nearly every publicly traded company in the United States. This includes the massive trillion-dollar tech giants, the mid-sized healthcare providers, and the small regional supply chain companies. The second component is a total international stock index fund. The United States market is powerful, but it does not represent the entire global economy. By adding an international index fund, you capture the economic output and growth of markets in Europe, Asia, and emerging economies. If domestic markets experience a prolonged flat period, international markets may offer a counterbalance. The third component is a total bond market index fund. While stocks represent ownership in companies, bonds represent a loan. You are lending money to corporations or the government, and they pay you fixed interest. Bonds typically grow slower than stocks, but they are generally more stable. They act as the shock absorbers for your portfolio. When the stock market drops violently, your bond allocation helps smooth out the ride, preventing you from panicking. Together, these three funds give you ownership in over 10,000 companies worldwide, plus thousands of secure bonds. You own a piece of human economic progress across the globe. Here's where this becomes important for someone balancing a full-time job and a personal life. The primary advantage of this portfolio structure is that it is entirely self-cleansing. If you own a total stock market index fund, you do not have to monitor quarterly earnings reports. If a company begins to fail and its value drops, its weight within the index fund automatically decreases. Eventually, if it goes bankrupt, it simply falls out of the index entirely. Conversely, when a new, innovative company rises from obscurity to become a market leader, it is automatically added to the index, and its presence in your portfolio naturally expands. You do not have to hunt for the next big thing. The index fund finds it for you by default. Another major benefit is extreme cost efficiency. Mutual funds managed by human stock pickers often charge high fees. sometimes 1% or more of your total portfolio every year just to pay the management team. Index funds are automated, meaning their fees, known as expense ratios, are often a fraction of a percent. Keeping your investment cost low is one of the few guaranteed ways to keep more of your own money compounding over time. The difference becomes clear when we run the numbers on realistic, non-ideal life situations. Consider a 32-year-old who recently went through a major career change. They feel like they are starting late and have zero retirement savings. They are currently earning $65,000 a year and commit to investing $400 every month into this simple 3-fund portfolio. Instead of using overly optimistic historical highs, let's assume a conservative inflation-adjusted return of 6% annually for their specific mix of stocks and bonds. Over a 22-year timeline, bringing them to age 54, they will have contributed $105,600 from their own income. However, thanks to the mechanics of compounding within these broad funds, their portfolio would have grown to roughly $224,000. They more than doubled their wealth, not by predicting the future or taking massive risks, but simply by capturing the average growth of the global market for 2 decades. Now let's look at a different reality. What if your income fluctuates? Imagine a 24-year-old freelance graphic designer. Some months they secure major contracts, and other months are quite lean. On average, they manage to invest $200 a month into their portfolio. Because they are young, they allocate mostly to stocks and take on slightly more volatility. Let's look at a shorter, 15-year horizon, assuming an 8% average annual return, which aligns with broader equities during solid economic periods. In 15 years, this freelancer will have invested $36,000 of their own money. Their portfolio, however, would sit at approximately $69,000 by the time they are 39 years old. This provides a tremendous financial safety net and a strong base from which they can scale their investments as their freelance business stabilizes and grows. The math works whether you are a corporate executive or an independent contractor. Before we discuss the biggest mistakes beginners make with this setup, we must address the reality of market behavior. All investing carries inherent risk, and it is entirely possible to lose money. Always conduct your own independent research or consult with a licensed financial professional to ensure any strategy aligns with your specific timeline and risk tolerance. Now let's look at what most beginners miss when trying to implement this strategy. The most common error is accidental overlap. Many new investors will open a brokerage account, buy a total U.S. stock market index fund, an S&P 500 index fund, and a large cap technology ETF. They look at their dashboard and think they are incredibly well diversified because they hold 3 different funds. In reality, those 3 funds hold almost the exact same large American companies. If the U.S. technology sector experiences a severe downturn, all 3 of those funds will drop simultaneously. True diversification means buying assets that behave differently, which is why pairing a domestic fund, an international fund, and a bond fund is the logical foundation. The second mistake is the urge to tinker. A proper index fund portfolio is designed to be boring. When you see financial news networks screaming about an impending market crash, or when an acquaintance brags about a highly speculative asset that doubled in a week, the temptation to abandon your strategy will be intense. Rational wealth building requires you to ignore the noise. The moment you start selling your index funds out of fear, or stopping your contributions to wait for the perfect time to buy back in, you interrupt the compounding process. To bring this all together, your first investment portfolio does not need to be a masterpiece of financial engineering. By combining domestic stocks, international stocks, and stable bonds, you instantly own a slice of the global economy while protecting yourself against localized market crashes. You eliminate the need to research individual companies, you drastically minimize your fees, and you position yourself to capture long-term economic expansion. Wealth is rarely built overnight. It is constructed methodically, month by month, through the consistent execution of a simple, logical plan. If you have your accounts open and understand these asset allocation basics, the next challenge is managing the psychological side of investing when the market inevitably drops. If you found this breakdown valuable, consider subscribing.